Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. As always, got some very important topics to understand and companies that, well, I think you'll find them very interesting. We're going to start off with a May retail sales look stronger than headlines show. And this is very important because we keep getting this feeling that there wants to be bad news, but we keep finding news that, well, it's not so bad. So we'll talk about that. This was kind of surprising to me, but when you think about it, it's true. But ChatGPT and Perplexity, they're actually hurting the internet. They're not helping it. They're actually hurting it. We'll explain why that is. And then why are big retailers looking at issuing stable coins of their own? I found this also very interesting. And I hate to say it, I like things the way they used to be, but you can't stop progress. And this could be something that progresses in the future.
Well, you say you don't like the way things used to be, but the funny thing is now you're used to it. Right. So like 10 years ago, you would have hated change, but now you love the change. So who knows? 10 years from now, you've been like, oh, actually, maybe these stable coins weren't so bad.
And that's what it could be. But, well, we'll talk more about that when we get to it. we got some great companies we're covering today. What are we covering today?
Yeah, companies we're going to take a close look at today include Adobe, T-Mobile, Jack in the Box, nice San Diego-based company here. And then also to end that, we're going to look at Celsius. So 4 good stocks, break down the fundamentals, give you an idea of what we think of as buy, sell, or hold based off the numbers we see here today.
And I got to tell you, I took a brief look because I had to find the symbol for Jack in the Box. We'll find it out for sure, but that could be a screaming buy. So you got to stay tuned to the second half of the show because there's something that I think it's down like 80% or something, and I don't know why. Maybe we'll find why. But if not, that could be a screaming buy.
We'll see. We're excited to take a look at that and the other 3 companies.
Yep. All right, well, let's talk about some May retail sales because looks stronger than the headlines show. And after seeing headlines from several media outlets, I was worried that May retail sales were slowing to a problem point where, we got problems showing up here. But compared to April, sales did fall 0.9%, which was larger than the expectation for a decline of 0.6%. But it's just like, that's only the surface. And you just read, this is why you get in trouble reading headlines. Oh, yeah. You read headlines, oh my gosh, things are terrible. You got to dig into the meat.
Yeah, and I was working from home on Tuesday because my daughter was actually born on Father's Day. So.
Yes, we've been waiting. Waiting, finally.
So I was a little bit out of it Monday, Tuesday, and I'm going through the news, catching up what's going on, and I'm like, oh, gosh, that's not good. And then you kind of start digging through the numbers here, and I just got to point out, and we knew this was going to happen. Consumers, they rushed to auto dealers in April to try and beat those tariffs, and that led to a 3.5% decline in motor vehicle and part dealers when comparing sales in the month of May to April. Not surprised by that. Also, we talk about gas stations. They've also been seeing declining sales largely due to lower gas prices, and they fell 2% when compared to the previous month. If you exclude those two, I'm going to say volatile categories, sales actually would have fallen just 0.1% when compared to April. Not bad at all. I mean, but again, I was reading the headlines, and I was like, it's like, the consumer is starting to buckle. And it's like, well, I don't know about that.
and if I would bet there's people know, except for California, gas prices have gone down. But I bet you they don't make that relationship to saying that's part of retail sales. I think when people think of retail sales, they think of grocery stores and everything else. They don't think about the gas sales as part of retail sales.
Actually, I got this comment on YouTube saying, what is this idiot saying? Everything's gone up, the price of beef and the price of gas. And I'm like, well, I don't make up the CPI numbers. I look at the data here. And maybe, this gas station you go to, maybe their prices haven't fallen. But you look again on the national scale, gas prices have fallen, especially look year over year. I know you get into that too.
Yeah, exactly. And while the month-over-month numbers point to a slowing consumer, when we look at the annual comparisons, this is very important. The numbers, well, they're actually impressive. And think about this year over year. Headline, retail sales climbed, didn't decline, but climbed 3.3% compared to last May of 2024. But if we exclude motor vehicle and parts dealers and gas stations, these numbers get amazing, Sales climbed 4.6%, and this was largely impacted by the 6.9% annual decline at gas stations. And this is why many times a small investor loses out, because they read the headline, they don't understand what's really going on. They sell, shouldn't be selling, depending on what you have, obviously, but they sell, and then like, things went up. What did I know? You didn't get the meat. That's why we do the Smart Investing Show, to help people out.
And we say this time and time again. And, this gentleman on YouTube that's like, oh, beef prices. And I'm like, yeah, maybe beef prices are up. But you can't just pick one thing. I mean,
Right.
You could have talked about when inflation was slowing and egg prices were up like 60%. It's like, oh, my gosh, inflation is terrible because egg prices are up. Even when inflation is in check, you will be able to find categories that are having difficulties. So, I mean, you can't pinpoint one little specific data point. You have to really kind of view out here and look at the big picture, because that's what's important. That's what drives the economy, not prices for individual items. It's, again, on the mass scale here is what we want to look at, is that's going to give you a better guide for the economy going forward. And, I mean, speaking about a better guide, I mean, we're going to look at areas of strength here. I'm going to say, not too surprised, non-store retailers, those continue to do well. That's obviously your Amazon and online shopping. That was up 8.3%. We've talked about this here a lot as well, but food service and drinking places, that was up 5.3%. That, again, is something that if tariffs are terrible, the economy is terrible, that is going to be one of the first places you cut, because that is truly a discretionary expense. And the last area that I was kind of surprised by was furniture and home furnishing stores. They were up 8.8%. So, again, those are some big positives that we saw from retail sales.
Yeah, and these are things that you have to kind of look at to understand what is really going on. And these numbers, the person that said that, well, beef prices are up, don't you go to the grocery store? We've said this many times before. We'll say it again. That report includes thousands of items. So just because beef and a couple things are up, you think maybe your inflation's up because you're buying beef. But a vegetarian, well, they don't care. They're not buying beef. So that's why it's a major report, and we report what the numbers are. And also, too, people got to realize this is nationwide numbers. And when you invest in the stock market or real estate nationwide, you want to know national numbers. Who cares about San Diego? You got to look at the national numbers. So very important to understand what you're looking at and looking at good data. Yeah,
and I do, again, want to be clear to people listening, and I've said this time and time again, I don't think tariffs net are good for consumers short term. And, I wouldn't be surprised if you start to see retail sales, again, kind of slow down a little bit. I mean, I was blown away by that 4.6% annualized number. I mean, that is a very, very strong number there. I'd be surprised. I'd be hard pressed to think July, August, September, you're going to see that type of growth. Could be wrong, but I think that is, again, a very healthy level for the consumer.
And it's also important to understand that is 2024. 2024 was a decent economy. Yeah. Wasn't like way down, so not going from a low number to high number. You're talking about a normal economy versus now 12 months later up, 4.6%, you said.
Yeah, and I do got to say as well, it will be interesting. I'm sure you saw the Fed Governor Waller came out on Friday saying that, we could cut rates in July. And he kind of said, and President Trump has talked about this a lot as well, but, why are we waiting for the economy to get terrible before we actually start cutting? And I think there's some credence to that. The big question is, again, the inflation is, if inflation remains in check, I don't see why they can't cut. Again, a quarter point's not going to make a huge difference in the month of July, which I think would be a positive for the stock market here as well.
And I think we'll get one more report on retail sales, inflation before that happens. I think it could be a possibility to cut in July, because you can't keep saying, well, I know that Powell says that he's, uncertain because of the tariffs. Well, that's then going to give you 2 strong months, actually 3 months of tariff data. Yep. And if you still haven't really seen, and that's why we watch it all the time, if you really haven't seen anything major by that 3rd month, I feel kind of like, okay, maybe it's not going to be as bad as I expected.
Yeah, I mean, you can do one cut in July and then wait till September or something. And then, because I know Waller, I think, is a little bit more dovish, it appears.
Right.
I think that there's, 19 governors or voting members, and on the dot plot, I think 10 of them had 2 to 3 cuts by the end of this year, but then the other 9 had 0 or 1 cuts. So, again, these are all over the board.
Right.
We'll have to see meeting by meeting. I think Waller's an outlier. I don't think July is a super hot meeting where it's likely you'll see a cut. But I think it's starting to become a possibility.
And I don't know the exact date of that meeting, but I know it is after, I think it's July 9th is when the reciprocal tariff extension or reprieve, whatever you want to call it, is over. Yeah. So we should have either new data or things don't look that good, but we'll have more data there. So we'll see what happens after July 9th.
Yeah, and we'll be covering it here on the show.
Yep. Let's talk about the Chat GPT and Perplexity, why it's hurting the internet. Well, think about this. Alphabet's Google search engine, they're seeing huge declines. And this is just not hurting Google. But think about this. It also hurts many companies who get their business from searching on Google. This could have a major impact on companies like TripAdvisor. This was amazing to me. It gets as much as 58% of its global visits from search. Now, I'm not quite like you yet. I still haven't gone to ChatGPT. I'm too lazy. I put in Google. They have that AI search right at the top. That's pretty much all I'm looking at sometimes.
Yeah, and we'll kind of address that here a little bit later on, but I think that could be a huge problem for Google. They're almost shooting themselves in the foot. But do you want to talk about why this is an issue? I mean, if you go to ChatGPT instead of using Google, well, I mean, there's no need to continue searching. So all those ads that you see on Google, well, you get one streamlined answer essentially on ChatGPT. You're like, hey, how do I make this for dinner? And it's like, bing, 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 it sends you all that. Where if you were on Google, you would all of a sudden be getting ads for like cheese and tacos and these different things. ChatGPT, you don't get that. You get one answer, no ads right now. It'll be interesting to see how that changes over time. But I mean, that is kind of going to be a big problem. And I mean, it's not just TripAdvisor. I mean, many companies from Netflix to U.S. travel and tourism companies are seeing declines in traffic to their websites by 10 to 20% from 1 year ago. For example, search referrals to the U.S. travel and tourism, they were down 20% year over year last month. And news and media sites, they saw a decline of 17%. So, I mean, this is a problem. And we did hear from Apple as well. I think it was last month or 2 months ago. They came out and said, yeah, the Safari browser is seeing less traffic to Google. It was the first time they've seen a decline.
What actually happens, because, again, you're more on ChatGPT than I am. I will do it. I haven't done it yet, but I will do it. But when I go to Google to search something, if I don't just use the AI thing, you do multiple searches. And every time you do that, it refreshes the page and you get new ads. If you just go up, correct me if I'm wrong, but ChatGPT, one page, one time, that's it.
Yeah, no ads.
No ads, yeah. So I do believe they will see ads coming up in the future, I'm sure.
Or you pay for it. I know that people are paying like $20 a month for it. And
yeah.
I mean, it is pretty worthwhile in my opinion. I might be willing to pay the $20 a month if they do start requiring you to pay for it.
How intrusive the ads are.
Yeah.
Yeah. So and it is amazing. You talk about how the growth of it. ChatGPT had 500 million weekly active user in March, and that was almost up 70% from the 300 million they saw in December. So I'm the guy that's way behind here. I need to go on ChatGPT, kind of look at it and start using it, because that's a lot of people. 500 million weekly.
Yeah. I mean, people are using it, and I'll admit I was a skeptic at first. And I was like, I don't get it. It's basically like Google. Well, it's better than Google. I mean, it gives you a summary in a much more efficient manner. So, I mean, I see the purpose behind it now. Sometimes, I wouldn't say I'm an early adopter.
Right.
I'd say I like to kind of let things kind of fizzle out, and then I'll kind of step in. And I'll admit when I'm wrong. And I think ChatGPT it's pretty amazing what it can do. But kind of speaking more specifically about Google, one of the other big issues for them is they still have that lawsuit. Multiple lawsuits, I'll say, for being a monopoly with the federal government. And it appears that will not disappear, because even though things have changed, they are being penalized for what they have done in the past. And I got to say, I think that's wrong. Why are you going to penalize them for what they've done in the past? That could hinder them in terms of the future competition. Now they're having to fight for their lives, essentially, to maintain market share. Why are you penalizing them for what happened, 5, 10, 15, 20 years ago, let's say?
Yeah, and I agree with that. When I read that, I saw, I kind of get it, because you can't say, oh, well, you're not being punished now. That's behind, that is past. But that the problem is gone.
Yeah.
They now are in trouble because they're not the big monopoly they were. And then if they do have to pay billions of dollars, that could pile on top of what they have. And I do want to point out, Google does have other good things like Waymo, YouTube. YouTube is huge. I've heard talk about it. They should spin off YouTube, but very interesting story for Google going forward. And I want to feel tempted to invest in it, but I'm just not quite ready yet.
Yeah, and I would say as well, the other issue here with Google is, and I'm going to say not the issue, but the beautiful thing I'm going to say with capitalism is this is why it's so amazing. People try and solve problems. I mean, Google's maintained this huge essentially monopoly on search. But now they've redefined search with ChatGPT and Perplexity and Grok AI, all these different AI services to create competition in a different way. And competition is a beautiful thing. And that is where I think it is so interesting that now the federal government could actually crush Google in this race against other competitors. Because again, they got to pay a fee for something that happened in the past. It's like, shoot, that leaves us less money to compete against OpenAI and ChatGPT. And I was going to say one other thing about the search function and the AI function on Google. The reason it's so problematic, I've used that as well, it pops up at the top of your screen.
Yeah.
Well, if you just use that, there's no ads. Like if I go into the Google AI, the top, I'm going to say half of my screen gives you the answer that you're looking for. All the ads are beneath that. If I'm a business, why would I pay the same price for ads that are now further down the page?
Yeah.
And I think, again, they're kind of shooting themselves in the foot. I think it could cause some issues, especially considering more than half of Alphabet's total revenue comes from Google search alone.
And actually, they're between a rock and a hard place, because if they just ignore it, they're going to lose more business. They use AI. Well, now they're not displaying the ads as much. They're in a tough spot. Yeah. And that's what I'm saying. I want to invest in them because of Waymo and because of YouTube, but I don't know how they're going to fix this problem. You said it's half of the revenue comes from search. That's a big...
I use ChatGPT. In 2024, Alphabet reported about $240 billion in total advertising revenue. About 175 to 180 billion came from Google search and other ads. YouTube was about 45 billion. So again, a nice sized business, but within Alphabet, it's so small compared to the other elements of the company that YouTube's going to continue to grow, let's say, but not at a fast enough rate to maybe displace some of this lost revenue from Google search. They also obviously have Google Cloud, which is non-advertising. That is about 40 billion. The other bets in miscellaneous, I mean, that's really not doing much for them. They are building up Waymo, but I mean, you have, again, $240 billion in revenue. They're not even making a dent in that number yet.
And for every negative, there's a positive. I mean, one company that could benefit from the decline in search is Meta. And I was thinking, too, as I was saying that, perhaps even YouTube could, because what's happening is that this would come from Facebook and Instagram platforms, because that's still a way for businesses to be online in front of their potential new customers doing that. And I think YouTube, again, has ads as well. So you can go online other places. There's still some concern. I want to point this out because we do feel very comfortable with seeing this information, but there are still some copyright infringements from many companies that are out there. And this could be something that really hurts the advancement of AI. So things are not done now. We could have changes that are, and again, we like it. You love ChatGPT because it's so quick, but there could be problems down the road. And every once in a while, you do get something that
isn't fully accurate. I always give the disclaimer. I pulled this from ChatGPT, so if you come back and say those are wrong numbers, it's like, hey, I told you it was on ChatGPT. And it's not the truth yet, but you know, it is a great resource, I think, in terms of utilizing resources for efficiency.
Exactly. Let's talk about why our big retailers issuing or looking at issuing stable coins out of their own. Stablecoins seem to be the new buzzword in 2025. I swear I can't pick up a Wall Street Journal at least once a week and see some headline with stablecoins. It's either stablecoins or Trump. those headlines they're always there. But you know what I'm looking at is I recently read that Walmart and Amazon may be looking into using stablecoins to get away from using traditional payment systems. And this costs them billions and billions of dollars a year in fees, which we've not heard about. We know that. And this includes interchange fees that occur when customers make purchases. Here's a famous one, using those credit cards.
And this is just something, we got an advertiser, I don't know if you saw this, they just sent us a thing that they're going to start charging the 3.5% merchant fee.
Who's going to?
I'm not going to say it on air.
So
something we use.
Oh, something that we use.
Yeah.
Well, yeah, somebody else.
And it's like, oh, now we have to think about, again, not using a credit card because it's like, well, I guess the ACH pull is going to be cheaper than maybe using a 3.5% fee for the credit card. And it's like, gosh, that's a bummer.
Yeah.
And it just seems like some of these merchants are getting so frustrated with the credit cards. Maybe these stable coins will be an alternative. And I know JP Morgan as well, they're talking about utilizing stable coins. I mean, there's all these potential use cases for it. And, you know, you might be saying, well, what is a stable coin? easiest way I'm going to put it here. It is a coin that is supposed to be backed by a 1-to-1 exchange ratio with dollars or other government currencies. In other words, reserves of cash in dollars would have to equal the value of the stable coins that were in the market. And it is kind of, I almost want to say like a money market that people are using to transact, because the whole point is it's supposed to have a consistent base to it. It's not like Bitcoin where it's going to be jumping up and down 5% a day. The key word here, stable coin. So that's why you can transact with it. And I think the reason people are utilizing it or looking at it is, again, it's on the blockchain. So it allows for the transaction to occur more efficiently and at a faster pace, essentially.
Yeah, and it's something that's, again, progress moving forward. And you wonder, well, who's going to be hurt the most by this? Well, guess who? Visa and MasterCard, who collect billions of dollars in fees from merchants, would likely be the ones most at risk. And I believe if the stable coins were to become a reliable source of these transactions, you could see Visa and MasterCard, and they trade at lofty levels. Last time we checked, they did. I think you could see those stocks cut in half. And they've had this long run, I'm going to say for like 20 years. Well, nothing lasts forever. And I think that they could be in some trouble.
I can't believe this. I mean, we know the Genius Act. I think it's a funny name, but it was passed in the Senate this past week, and now it's heading to the House. Visa was only down about 5%. And I'm like, that's pretty crazy considering this could be, I think, a huge hit to their business. And you talk about valuation, it still trades at over 30 times earnings. So, I mean, if you have declining business all of a sudden now and high multiples, I mean, that would crush this company.
And I don't think they have any other business.
I don't think so either.
Like Google has different businesses. Other people have lower revenue sources. MasterCard and Visa, one source, the fees.
Yeah, and I think that's where, again, Jamie Dimon, he's arguably the best banker of all time. I think he's so smart being ahead of things and testing out different things like the stablecoin, because that could be an opportunity for them down the road to maybe even steal market share from the payment systems that rely so much on Visa and MasterCard. And I mean, we talk about this, but merchants have tried in the past to somehow get around the card-based systems from Visa and MasterCard, again, by implementing merchant fees. It seems to be the latest way that they try and get around it, but I tell you, it pisses off the consumer.
Yeah.
But each time they have continued to fail at getting around these players. Because again, Visa and MasterCard, it's so easy for the consumer to use them. You get nice points, rewards. I mean, there's a lot of enticement to using those payment platforms. But again, things change. It could be a big problem.
And I got to admit, I don't feel 100% comfortable with the stable coins. I mean, it's a very simple concept, but there's more to it that you got to see behind the curtain, so to speak. And this is also true of many regulators. That's why perhaps it may not pass the House, because if you don't understand something, you don't want to pass something with the Genius Act, which, again, I don't know where that name came from. But it appears that the new technology is coming, and if Visa and MasterCard are replaced, well, I'm wondering, who gets the benefit here? Is it going to be, because all those billions and billions of dollars of transaction fees, who gets the benefit? The merchant? Are they going to keep all that? Or does the consumer get the benefit of that? I have my feelings, but what do you think?
I think it's going to be like tariffs, where it's the opposite, though, where, the benefit will be shared. So the tariffs, the costs are shared amongst the different players. I think this would be the same thing, because what should happen is the companies would get the initial benefit, or again, a company like JP Morgan Chase might benefit and be a new player in the space. But then also what they'll do is those companies will, now they need to fight for market share. So I'm going to cut prices a little bit to try and steal the consumer share of it as well. So I think on net, the benefit would be shared across the board.
I think it's going to be merchant. I think they're going to keep all the fees.
We'll see. I mean,
we'll see. Yeah. So
all this comes
from our newsletter. The Smart Investing newsletter goes out every Friday at 5 o'clock by email. Other topics on there are small business owners are optimistic. Airlines, well, they'll take your miles when you pass away. Why this is a fragile stock market. What happened to those alternative meat companies? Avoid watching a show on X called Going Public. And retailer at home files for bankruptcy. All this on our website, smartinvesting2000.com. Smartinvesting2000.com. Free newsletter goes out every Friday at 5. Let's jump right into our companies, because I know I want to get right to them. We're going to talk about Adobe, which are symbol is ADBE. Then the software application industry, not much short on the float here, 1.7%, 86% institutional owned. This PE ratio is good compared to what it used to be. It is 24.1 compared to the industry at 85.5. Price to sales 7.3 versus 6.7. Price to book value expensive 14, double the industry at 7. Price to cash flow does look good though, 17.2 versus 32. And the PEG ratio does look good, 1.4 versus not material for the industry. Now, their earnings did climb by 36% over the last year, well above the industry, up 7.8%. Sales for Adobe up 7.9%, not quite as good as the industry growth at 9.1%. They do get a 5-year earnings per share growth estimate from the analysts of 12.9%, while the industry gets a negative 0.8%. Unfortunately, they do not pay a dividend. Look at the balance sheet. They got a current ratio of 1.2 versus 2.1, so a little bit not quite as good as the industry. Debt to equity 0.5, same as the industry. Net profit margin 30.6 versus 10.6. That's a pretty good profit margin. I like seeing that 31%. That means they make 31 cents on every dollar they bring in. Return on equity also good, 51.6 versus 15.6. And free cash flow, wow, 9.1 billion versus 2.9 billion for the industry. What do you got, Jace?
Yeah, so current price here for Adobe, again, their ticker symbol ADBE, well, it's $376.92. 52-week range, the low here, $332.01, and the high, $587.75. Over the last year, the stock's down actually about 28%. Even the last 5 years, wow, the stock's down 14%. Over the last 10 years, though, up 356%. So, over that 10-year period, the first 5 years were great. The last 5 years have not been so great. But looking at the valuations, I'm going to say a little bit surprised by this. Valuations are okay. I go out to November 2026. The estimated earnings per share of $23.16 gives us a target sell price of $384.46. So forward PE, I'm going to say is around 16-ish, which wouldn't constitute a buy. And I say the valuations look okay because I think for years it was like 30, 40 times earnings. So you're finally getting this company almost on a discount. But talking about ChatGPT, that worries me for this company.
ChatGPT, why does that worry you for this company?
My sister-in-law, she works in marketing. Right. And what she does is she actually types in like on ChatGPT, create me a marketing flyer for this event. And ChatGPT will create the flyer. A lot of people use Photoshop on Adobe or, their different kind of software tools to create stuff like that. So it could be a problem for them long term that these other players are able to kind of, again, step in and steal market share from these Adobe creators that utilize the PDF function.
And just talk about Visa, MasterCard having a one-type brand for their item, for their revenue. Is that the same thing with Adobe? Is that all they primarily do?
I think Adobe has other stuff. I mean, I think they have like Adobe Sign, so they kind of fight against DocuSign a little bit. I think they also have, we use Adobe in the office here.
End of the show. End of the first half. Gosh, it goes by too quick. All right, stay tuned when we come back with our financial planner, Harrison, coming up, talking about the widow's penalty and those 3 companies left, T-Mobile, Jack in the Box, and Celsius. Stay with us. We'll be right back. All righty, welcome back to the second half. This is where we pick up and talk about financial planning. For that, we turn to our financial planning expert, Harrison Johnson, CFP. Harrison, I got to lead with this, the widow penalty. I think I've heard that before, maybe not, but why don't you explain what you're talking about here?
Yeah, it's not an actual penalty. It's more of just kind of what happens. But if you have, a married couple, they're in retirement, when the first spouse passes away, it's the phenomenon where the surviving spouse generally has a reduction in their income. I mean, on the first side with Social Security, when 2 spouses are both collecting Social Security and the first one dies, the survivor keeps the higher of the 2, so that lower Social Security gets dropped. There might be other income sources that get reduced as well, depending on pensions and things like that, but there's a reduction in income, and then there's also generally an increase in the tax rate on that remaining income, because now that surviving spouse has to start filing as a single person as opposed to a joint filer. So as a single filer, they climb up the tax brackets into the higher rates on lower levels of income. Their standard deduction is reduced compared to a joint filer. So it's kind of like a double whammy. You have less income and then more taxes on that income typically.
And it sounds like, maybe you'll correct me if I'm wrong here, but it sounds like not much you can do. Kind of is what it is.
Well, it's something to be aware of, and
You take this in your planning when you're going forward. Is what you're
yeah,
saying. Okay.
yeah. So I mean, part of it is you have to know that this is going to happen. So I pulled an example. If you have a married couple that has $150,000 of income, 50 of which coming from Social Security, and then 100 coming from an IRA or a pension or something like that, that would continue. When the first spouse passes, if half of that Social Security goes away, their income goes from 150 down to 125. At 150, their total tax, federal and state, they'd be in the 22% federal tax bracket. At that level, if they're in California, they'd be in the 6% tax bracket. So their total tax rate or total tax would be about $17,000 on that $150,000 of income, which is an effective rate of about 11%. After one spouse passes, that 150 would go to 125. Their tax burden would increase from $17,000 a year up to about $25,000 a year, pushing them into the 24% federal bracket, 9.3% state bracket, and then that would start to trigger IRMA in that case as well. So you lose $25,000 of income, your tax increases. So ultimately, their take-home pay for the surviving spouse would go from about $11,000 a month down to about $8,300. So for every situation, it's a little bit different. But again, it's something to plan for when you're determining how to structure Social Security, when you're determining how you should be structuring withdrawals when both spouses are alive, and then, making sure that you're not depleting those assets too quickly if that surviving spouse is going to need maybe to withdraw more to offset the reduction in income. If you have a lot of pre-tax money, looking at maybe converting that over into a Roth so that the survivor doesn't have large required distributions pushing up into larger brackets. So there's things that you can definitely plan for, but the reality is a surviving spouse is generally going to have a couple more complications to worry about that they didn't have to while they were married.
And I say too, the problem is, I say this, one spouse generally spends more than the other spouse.
Very dangerous. Don't go too far with that.
If the spouse, and sometimes it's men. I mean,
What do you mean sometimes it's men? You're referring it's women?
You're in trouble.
Oh, gosh. Hey, men have their hobbies too. You're a big car guy.
Right.
Your wife's not, so she wouldn't have the car expenses if you passed away.
Okay,
but
you went on that one.
My point being here is, if the spouse that spends more money is the spouse that lives longer, I mean, that is a real big problem, because if they all of a sudden get their income hit, well, their expenses, they'll go down a little bit, because obviously now there's not two people eating, but that's not enough to offset that decline of, what'd you say, about $30-ish, $32,000 a year?
Yeah, a little over about $3,000 a month. So depending on the situation, it could be substantial. You're still going to have a mortgage, so you're going to have property taxes if you have a mortgage, unless you pay it off. Property taxes, homeowners insurance, maybe your auto insurance isn't as much if you can get rid of a car. Like you said, you're not going to be eating as much. But again, in many cases, the reduction in cash flow that you need might not be as great as the actual reduction in after-tax income.
Yeah. So I think it is just something you got to really be aware of, because that has to be planned for.
And it's obviously not a nice thing to plan for. I had a meeting earlier this week, and we're talking about, okay, well, right now everything's fine. As long as both of you are alive, everything's fine. But if something, you're probably not going to die at the same time. It might be close to each other, but generally one spouse will pass, the survivor will live on, and in many cases it can be quite a while. So you need to make sure that surviving spouse is going to be taken care of, and I think everybody pretty much wants that for that spouse. So.
And I kind of wanted to. A lot of people are like, I don't need financial planning. I got it covered. I wonder how many people don't think about that situation, because it's just something that you just don't think about it.
A lot of people don't think about it. Yeah. And retirement can last a really long time. I had a spouse, or I had a people that I'm working with, and the wife just retired earlier this year, and then she sent me an email. Her husband passed away unexpectedly at 67, and she's 64. So now she's got a long time in retirement. I'm going to meet with her next week to kind of go through it. But that's an example of all the things that she was thinking of are going to be totally different, because now she's going to be single going forward. She's going to be fine because she has the assets and income, but her tax rate is going to be higher than what we originally expected, because we thought they'd both be around for a while going forward.
And that hurts the Roth conversions, and the plan changes. And I think that's one thing we always talk about with financial planning you can't do a static financial plan. You can't be like, well, in 5 years, this is what's going to happen. I mean, life throws you curveballs, and you have to essentially plan for the unexpected and take it as it comes.
And that's always going to be the case. I mean, I put plans together, and then someone will come back and say, okay, well, now this changed, so we got to redo it all. It's like, no, it's supposed to be able to evolve. It's supposed to put you in a position where you can react to whatever comes at you, because the reality is your life will change, and then the world around you will continue to evolve. So you need to be able to react to that and be in a position to do that.
And that's one thing too. People go through the retirement ones. You've gone through it hundreds, probably thousands of times now. So you know what to expect. Where people just like, I didn't know that because I haven't done it hundreds, thousands of times.
In many cases, when you're figuring out that there's a problem, when someone figures out there's a problem, there's not much that you can do about it.
Yeah.
So the time to prevent those from actually becoming financially impactful problems is to plan ahead of time and know about them. And so this is, again, another topic to talk about.
Great. Well, Harrison, thank you very much. We appreciate it. And again, if you want to contact Harrison Johnson for a free consultation, he is a CFP, go to the website, smartinvesting2000.com. That's smartinvesting2000.com. You can send an email there or call the office, 858-224-0004. Again, that's 858-224-0004. 0004, and that's for a free consultation to see if financial planning will help you. Well, Chase, let's move on to our next company here. Let's see. We're talking about T-Mobile. I know they got rid of that how do I say this? That exotic CEO,
John Ledger, I think his name was.
Yes.
He was, but he'd call Verizon and AT&T Dumb and Dumber. Yeah, he was he was a good CEO, though. I think.
Yeah.
I mean, he really
did a great
put T-Mobile on the map. I mean, they've done phenomenal.
But he was rather eccentric, I think the word was. He had some crazy things he said. But anyways, at T-Mobile, their symbol is TMUS in the telecom services industry. Not much short on the float, 3.2% short. That's not bad. I don't understand this. Institutional ownership only 37.5%. I wonder if there's more than one class of share here, or is this owned by a lot by individual people? That's kind of surprising.
What was the institutional ownership?
37.5. Usually it's in the 70s, 80s minimum.
That is interesting.
Yeah, institutions, because that includes your mutual funds and foundations. Yeah, so that's surprising. See if you can look at that while I'm kind of doing this here. But PE ratio looks 21.7 versus 22. That's okay. Price of sales is expensive, 3.1 versus 1.3. Price of book value, very expensive, 4.1 compared to the industry at 1.7. Price of cash flow, 10.7 versus 4.7. And the PEG ratio is only 0.9. There is nothing there for the industry. Now, their earnings over the last year, up 39.3% above the industry at 24.5. Their sales rose by 5.3%, which is also above the industry at 0.7%. They still are expected to have a high growth rate based on the analyst for the 5-year earnings per share growth estimate at 21.7%, while the industry is expected to decline by 5.5%. I don't know what they're doing to get that type of growth rate, but they got something good going on here. Dividend yield on the dividend about 1.6%. They use 30% of their earnings to pay that out. Balance sheet, current ratio 1.2. That is better than the industry at 0.9. Debt to equity is high at 2.0, but this is a high debt industry. 2.1 is the industry average. They do also have a lot of intangible assets. 53.5% are intangible assets, and those can be dangerous because if the value declines on those, got to write them down. That can actually hurt the company's balance sheet, so be careful of that. Net profit margin for T-Mobile, very good, 14.4 versus 8.8. Return on equity, 19.5 versus 15.2. And free cash flow, $11.9 billion versus $9 billion for the industry. Pretty impressive there. What do you got?
Yeah, so current price here for T-Mobile, again, their ticker symbol TMUS. It's $221.52, 52-week range. The low here, $173.74, has fallen from the high of $276.49. Stock's done well, though. Over the last 5 years, it's up about 110%. Over the last 10 years, you're up about 472%. So again, talk about, I'm pretty sure his name was John Ledger, CEO. I mean, he really did, I think, a great job growing this company. And now the new CEO, I'm not sure who it is. It appears that the business has been running on all cylinders. My wife actually uses T-Mobile. I think if I wasn't on the company plan here for my phone, I think I would probably be on the T-Mobile plan because we use the T-Mobile internet. And it's great. And then I get free Netflix, I get free Hulu, I get free Paramount Plus, I get free Apple TV. So my streaming costs are now $8 a month. I know you guys talk about cable. I am way ahead in terms of how much I used to pay for cable versus how much I pay for my streaming services now. So, I mean, I like T-Mobile. I think they do a great job in terms of the service side, but I don't think I would buy the stock. And I say that because it's still expensive. You go out to December 2026, you see estimated earnings per share here of $12.69. You apply that 16.6 multiple to that, we get a target sale of 210.65. So the stock still trades over 17 times earnings.
You know, and I'm wondering, because you mentioned that you get free Netflix, free
Paramount Plus, free Hulu, and free Apple TV.
Okay, so how are they doing that? There's somebody that has some type of deal with those companies, but it's not free.
Oh, yeah.
Somebody's paying for it. They paying for it. They're giving something else up on it. I mean, I'm not asking if you know the answer, but I'm just put that question out there because it does worry me a little bit.
I mean, my guess is, you pay for the phone line and it's still not inexpensive. And this is the thing that sucks. When you have one person on the phone line, it's like the same cost essentially of having two people.
Yeah.
You get screwed being a single person in the phone system. So let's say that's $100 and something a month. Plus then you have, the home internet. I think we pay around $50-ish a month. So we're paying $150 for phone and internet. Well, then they probably get some deal from, I'm pick on Hulu, that's $10 a month. Maybe they get it for $5 a month. So you're able to kind of offset some of that cost because they're buying in bulk, but then they still have such nice profit margins from the phone and the internet to kind of then go out and negotiate on behalf of the client potentially to get better rates for the different streaming services.
Yeah, I just... Well, do you mind just disclosing what Taylor pays for what you pay for one line?
It's $150. I believe it's $150 a month for phone and internet.
Oh, for phone and internet.
Yeah.
Okay. All right. Because I know for my Verizon, I pay for two phones. I think $118 a month.
That's what I mean. If we were to add a phone line, it wouldn't go up very much.
Are you trying to convince me to buy T-Mobile for our company?
No, it's really not any different in terms of the cost.
But I have heard. I know my wife, when she had T-Mobile, she had a lot of places. Like even going to my house in North Poway, she'd lose connection.
And I'm not sure. I know they invested a lot of money in 5G, buying that broad spectrum or whatever it's called. I'm blanking on the name of it. But that, I think, has maybe helped the service a little bit. But again, I'm not an expert in terms of the actual technical side of things. But yeah, Taylor's phone, my wife's phone, I haven't noticed any issues.
Next time she comes to my house, see if she can get it, because I kind of live in the back area of Poway, and see if she loses connection or not.
Yeah, and I did want to say one other weird thing, though, about T-Mobile. The stock actually was down this past week. SoftBank is actually a large owner of their shares. As of March 31st, they held about 85.4 million shares, which was about a 7.5% stake in T-Mobile stock. They actually ended up selling about 21.5 million shares this past week for about $4.9 billion, which is about 2% of all T-Mobile's outstanding shares. And again, they still have a good amount. Or are they going to continue liquidating that? That could put more pressure on the stock. But I was shocked by this. I don't understand this part of the story. There's Deutsche Telekom. They own, and these numbers are crazy to me, direct economic ownership is 46.2% of total outstanding shares.
Of T-Mobile. Could that be why the institutional ownership was so low?
Yes, That's what I believe. And, I'm not sure what their plans are in this situation. But again, if they start being like, we need to monetize assets, we're having a hard time with our own personal cash flow. We have this economic ownership in T-Mobile, we're going to start liquidating that. That, again, hurts T-Mobile stock. And we know that T-Mobile's valuation at, again, I'll call it 17 times earnings, is much higher than Verizon and AT&T.
Yeah. So
I think more than double.
They've done well over the years, but I just and that's why probably SoftBank could be unloading some of it because they had great profits. But actually, it wasn't that phenomenal. I think you said the 10-year return was 400% or 486 or something. Yeah,
which is really good.
Yeah. Well, I mean,
we save your money can double every 10 years. That's pretty good. That's way more than double.
Yeah. I guess I was expecting something higher. That's what I was thinking. So it's very good, but not as good as I thought it was going to be. Okay. So let's move on to one that could be a screaming buy, and we will say this at the end if it is or not, because we'll check into it for you. Jack in the Box is a company. And I got to tell you, Jack in the Box was the first, and again, the corporate office I worked for, first came to San Diego back in 1983. Remember, I made $8,000 a year. That's all I was making as a junior accountant then. So, but I had a little affiliation with the company. I did buy the stock over the years, made some good money from the company. But Let's talk about it. Jack in the Box, their symbol is JACK, Jack. In the restaurant industry, short 32%. There's some problems with this company, so we got to find out what they are because it could be a screaming buy or it could be a value nightmare here. So, well, they have no earnings, no PE ratio there, so not a good start. The industry's at 31.1. Price to sales 0.2 versus 2.5. That is a positive, but no price to book value, which means that the liabilities exceed the assets. That's not good. Price to cash flow 2.3 versus 17.4. They do have a good PEG ratio, 0.6 versus 20.7 for the industry. Now, for the 1 year, there's nothing on the earnings growth, so it's probably negative. I guess they have no earnings maybe the last 24 months. The industry was down 3%. Sales for Jack in the Box, down 6% versus 6.5%. My excitement's waning here. 5-year estimated growth on the earnings from the analysts, 6.5% versus 6.4%. Now, they do pay a 10.2% dividend. Now, before you run out and buy the stock, I would have to guess that it's probably going to be cut, if not eliminated.
I, without even looking at the numbers, am 95% sure that dividend will get cut. Yields don't get to 10% without concern.
Yeah. And there's something here which we haven't found yet what the problem is yet. Let's see. The payout ratio, nothing there. Free cash flow payout ratio, 114%. So they're using a lot to pay that dividend out. Look at the balance sheet. Current ratio, 0.5 versus 1.1. So they're really lacking liquidity, and that can be a problem. They could be forced in bankruptcy without liquidity because they can't pay their bills. So that's a problem. Let's see. Net profit margin, a negative 13.7% versus a positive 8.3%. Return on equity is very good, though, 21.4 versus 378. Free cash flow is only, I guess, $30 million versus $2.8 billion for the industry. So I don't know what the problem is yet, but I'm going to look at the financial statements while you're giving us the numbers going forward.
Yeah, and I'll give the current price here for Jack in the Box first. It's $17.25. I'm going to let you pull this out, but you had the high for Jack in the Box or something in terms of their stock price. Didn't I see you jot that down?
Yes, I did. The high was $115 on May 2021.
Wow.
Yeah.
So it's definitely fallen a lot. I mean, their 10-year return down about 80% over the last 5 years. That stock has fallen 75%. Over the last 1 year, it's down 66%. So a lot of these issues have really come about within the last 1 to 3 years, I would say. And one thing I always forget about with Jack in the Box is they actually bought Del Taco in March 2022. They announced the deal in December 2021. So everything was flying high in 2021. Yeah. And then they announced this acquisition, which I thought was kind of strange to begin with. But it appears like that integration is not helping. That stock has just been decimated since then. But looking at the numbers, I mean, you look purely at valuation ratios, which, again, you always got to be careful when you're a value investor. You don't want to fall for a value trap, and maybe Jack in the Box is, because the valuations look great. I mean, you go out to September 2026, estimated earnings per share here, $5.14. It gives you a target sell price at $85.32. It trades at 3.3 times those future earnings.
How many analysts is that?
20.
What is the high and the low estimate?
The high is $5.55 and the low $4.50.
That's because I would say
it's relatively tight, I'd say.
Yeah, and you use the lowest one, you still get a target price of probably 70.
Yeah, I mean it's still, let's see, you're still going to get a target sell price of $74.70 if you use the low. So I mean the valuations look phenomenal on this, and I mean personally I like Jack in the Box. I know you had the affiliation when you worked at Food Maker.
Yeah, Food Maker was a corporate name. Yeah,
but I mean Jack in the Box was probably my favorite restaurant. I remember you used to take me there and we used to get the ultimate cheeseburger when I was a kid. And then the milkshakes were always really good in the Jack in the Box. And even when I went to college, remember they had they're called munchie meals.
Right.
And that was their late night menu. And you would get like a cheeseburger, 2 tacos, and curly fries for like $5 or something crazy. But I love Jack in the Box. I haven't eaten there in a while because my wife tries to make sure I eat healthy now. But
Jack in the Box is healthy.
That's a hard one to spin. But I think there's potential here if you can understand what is going on with these problems.
Yeah, you got to find out what the problem is. And I do see that they do have about almost $3 billion of debt. Their equity is a negative $976 million. Balance sheet is kind of weak. They don't have much cash. They got about $16 million, it looks like, in cash. I know that they are, I appear, because they used to be the corporate headquarters was on Balboa, and I forget the cross street there. But I drive by there after doing my TV segment on KUSI, and it's completely torn down. They're building some massive building. Now, I don't know if they sold that, or is that Food Maker now, Jack in the Box, that is actually doing that. But
did they move? Yeah, because I know exactly. It used to be right over there, and what was that, Kearney Mesa?
Yeah, Kearney Mesa, and we can't get it because it's too small. I think the market cap now is like $300 million. But I think for a smart investor to do the research and find out what is the problem here, because the analysts don't seem to be worried about it. The debt, it's a little bit high, but this could be a runaway train here that does very well with a lot of risk on it.
And it looks like the address is still 9357 Spectrum Center Boulevard in San Diego, which I believe is where it was, or at least it's still in that same vicinity.
Yeah, it used to be on Balboa.
Okay.
I think it was like gosh, we're talking about 40 years ago. I think it was like 9,330 or something. I don't know.
Yeah,
right across from Cubic Corporation.
And I think as you said, it's too small for us now. But how do I say this? If I was a risk taker, I think this would be very intriguing because that balance sheet is a problem. Jack in the Box could file bankruptcy before the company turns around.
Yeah.
But if not, I mean, the earnings power there, the cash flow power is there. It's just a question of, can they get that debt situation figured out? If they can't, they go bankrupt. If they do get that debt figured out, I mean, this could go back to 80, which would be a huge return for you.
Yeah, and the trailing 12 months, they do have net cash provided by operations, a positive 144. So that'd be probably $1 million. So there's, if we didn't manage $700 million, I'd say, gee, we should maybe look at this a little bit deeper. But
we couldn't. The debt. I mean, they have no equity. I mean,
that's true.
There's too much risk in it for the way we like to manage money. That's what I'm saying. If I'm like, I'm feeling like a little bit like I want to go to Vegas today, maybe Jack in the Box would be a good gamble.
Yeah.
But that's not how we do things.
There could be more to it. Again, for the other investor, we can't do it, but you as the investor could. Find out what the problem is. I mean, read the news on this. Read the last conference call. What is going on? Because it may be a fixable problem. Then you'll be fine. But
I think you have too much affinity there because you work there. I think
I do. I think you're right. I'm not going to argue.
I don't think I would buy this stock. I mean, it doesn't fit the way I invest money.
Yeah.
We invest money.
I know, because we are more conservative, but it just I think there is a little bit of love with that
I
company.
just know if they filed bankruptcy and went to zero, be like, we knew it. This is exactly why we don't buy companies like this. You're chasing a dream.
I still remember the CFO, Chuck Duddles, took me to lunch one time, and we talked about the chocolate milkshakes made from real ice cream. And I was just so impressed, like, wow, the CFO took me out to lunch. All right, well, let's move on here. Oh, gosh, we're sticking about time. Talk about Celsius Holdings. CELH is the symbol. Beverages, non-alcoholic. Wow, here's another one. Short, 16.5%. Institutional owned, low, 57.7. PE ratio, 131 versus 25. Price to sales, 7.7 versus 2.8. Price to book value, wow, 25 versus 6 for the industry. And price to cash flow, also expensive, 44 versus 23. And you have a PEG ratio of 5.2. Industry's at 15.5, but still 5.2 is not a great deal. Wow, great deal here. Earnings down 64% over the past year. Industry down 9%. Sales for Celsius, well, they're down 6%. Industry down 8.2%. The 5-year earnings per share growth rate from the analyst, 9.9 versus 7.4. They do not pay a dividend. Look at the balance sheet for Celsius. Good current ratio of 3.4 versus 1.4, and no debt on the balance sheet. That is a positive. Net profit margin, 8.4 is not bad, but the industry is at 11.4. And then return on equity, 6.1. Free cash flow, $206 million versus $1.7 billion. I know my wife loves this. She buys them all the time. She drinks them when she gets up in the morning. Sarah's over there shaking her head like, yes, I drink those too. But I'm just not seeing it as a company. What do you got, Chase?
Yeah, I would say as well, analysts are kind of pointing to a little bit of excitement over this Alani Nu company. Never heard of them, but it was a $1.8 billion transaction, which I was kind of surprised by.
What does it have to do with?
Celsius purchased this company called Alani Nu, which they do like energy drinks, and it looked like some snacks and maybe some supplements as well. But it wasn't cheap. Again, $1.8 billion. I mean, that's an expensive acquisition. We just talked about the difficulties of potentially integrating Jack in the Box and Del Taco, this is like, wow. I mean, that's pretty expensive in terms of a company Celsius's size at $11.36 billion. It's not a small acquisition by any means.
Yeah.
But I got the numbers here. Got to digress on that acquisition. Look at the current price on Celsius. It's $43.37. 52-week range, the low here, $21.10, and the high, $62.68. It does look like back in 2024, last year, it did approach $100 a share. I mean, the stock really has done well. Over the last 10 years, it's up 4,700%. Over the last 5 years, it is up over 1,100%. I mean, the stock has been on fire. Year to date, though, it has not. I mean, you had to purchase it years ago. Oh, I'm sorry. Year to date, it's up 64%.
Yeah,
but the 1 year is where it's bad, down 30%. I mean, this stock is all over the place.
Yeah.
I mean, it is crazy.
And when did they do the acquisition?
It was announced this past week.
Okay.
Target sell price for Celsius is just $19.42 though. So definitely a sell.
And that $1.4 billion will show up on the debt on the balance sheet. So be careful there. All right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. 33014. Or go to the website smartinvesting2000.com. You can reach us there as well. Thanks for listening. We'll be back next week right here on the Smart Investing Show.